Alright, greetings. We are going to look at chapter 20, the final chapter in financial management. This chapter is about credit and inventory management. Alright, let's look at the next slide. I'm going to skip this slide. Okay, you can read on your own. This is not so important. I'm going to look at the overview of this chapter. Alright, this chapter can be divided into two parts. The first part is about credit or receivable management. We can use both terms, credit or receivable management. Okay, because credit will result in the company having receivables. So how we manage credit and how we manage receivables will be the first 7 topics. You can see, 6 topics. First 6 topics here is about credit or receivable management, and the last 2 is about inventory management. Okay, let me just get the pointer. One moment. All right. So the last 2 topics would be about inventory management. The major part of the chapter concerns is concerned with credit or receivable management. All right. Let's move on. Now, here we are going to look at the main issues in credit management, or receivable management. The first point here says granting credit generally increases sales. Why must companies grant credit? That means they sell on credit basis to their customer. Okay, generally it increases sales. It promotes sales because customers can buy now and pay later, right? Rather than buy now, pay now. So customers prefer buying now and paying later. So this is a kind of promotion. It promotes sales. It increases sales. Okay, if a firm does not provide credit, then the sales may be less. So by granting credit, there is an increase in sales. So this is positive. That is why there's a tick here, blue. It's positive effect on the company's cash flows. But there are also costs, as we have seen in many things, in finance. Okay, any decision that we make, there will be pros and cons. We have to weigh the two. We have to look at the cost and the benefit. Now there are also costs here, in granting credit. What are the costs? There are 2 major costs here. One is the chance that customers will not pay. You sell to them on credit, but they may not pay. So when they don't pay, then it becomes bad debts. So receivables don't turn into cash, they become bad debts. And then you write them off. It's a loss. Okay, it's a total loss. Because you lose the cost of producing the goods and you don't collect the cash. Alright, so this is one loss, one cost. The other is financing. So this is a marginal cost. Marginal here means quite small, actually, bad debts. If you manage your credit well, so these bad debts are likely to be small. For an average company, maybe about 5% of their sales will be bad debts. 95% will be collected. But the major cost will be coming from this, financing of receivables. Here it means that when you grant credit, a lot of your cash will be stuck as receivables. A lot of cash. So more funds are tied up as receivables if you sell on credit. Therefore, because more funds are tied up, you cannot use the funds, then therefore you need to borrow. You need to borrow or you need to finance. Therefore, there is more need for financing. If you give more credit, there's greater need for financing, and financing is not cheap. It is costly. Therefore, there will be costs implications for financing. So these are the benefit. You increase sales, therefore there is going to be some increase in cash flow. But at the same time, there are going to be some costs in granting credit. So there will be some trade-off. There will be a trade-off. There's a positive and there's a negative. Note this negative here, across. Okay, so the credit management examines the trade-off between increased sales and the costs. We try and obtain something which is, or try and attain, try to achieve optimal. Optimal here means you maximize sales minus the costs. Okay, that's the major issue here. Yeah, but it is not an exact science. Yeah, so you have to do trial and error. Yeah? In reality, credit management is more of a trial and error. Yeah, so that it's not an exact science. Okay, let's look at the next slide. Okay, still in the first topic. Yeah, components of credit policy. Yeah, there are three components of credit policy. Yeah, the first one is called terms of sale. A company's credit policy will cover these three aspects. One is the terms of sale, the second is credit analysis, and the third is collection policy. Yeah. Now, what do we mean by terms of sale? Yeah, terms of sale will include three other or three more categories of matter, or categories of subjects. So terms of sale here will cover credit period, then cash discount and discount period, okay, and the type of credit instrument. Yeah. Now, credit period is the term you allow the customer to pay. Yeah, the time you give to your customer to pay for the products that they have purchased on credit. That is what we mean by credit period. Yeah. Now, cash discount is the discount that you give to the customer if they don't take the credit period. They pay early. Yeah. So if they pay early, then they don't take the credit. Yeah. If they take the credit, then there's no cash discount. Yeah. This is actually to promote or to entice. Yeah. To encourage the customers to pay early, okay, and not take the credit. Yeah. But if the customers pay early, then you save on your financing costs. Yeah. You don't have so much funds tied up as receivables. Okay, but there is also a cost here, yeah, because you need to pay discount. Yeah, that means you collect less from your customer, but you collect early, but you collect less. Okay, this is cash discount. Yeah, and there is a discount period, meaning there is a period where you provide the cash discount. Yeah, beyond the discount period, the cash discount does not apply. Okay, so these three things, yeah, will come under the term of sale. Yeah, credit period, cash discount, and discount period. Okay, apart from that, you also have this type of credit instrument. Yeah, this type of credit instrument is actually an evidence, documentary evidence of indebtedness. Yeah, that means the customer owes the firm. Yeah, so there must be some kind of documentary evidence. Yeah, so for example, invoice. This is a very popular, or widely used credit instrument. Invoice. Yeah, invoice is actually a demand for payment from the customer, for the services or for the products sold, to the customer. Okay, there are other credit instruments. This is described in the textbook, page 714. You can read that. Okay, but that is what we mean by credit instrument. So all these three aspects come under the terms of sale. Yeah. Now, apart from the terms of sale, the credit policy also covers credit analysis. Yeah, the credit policy of a company must determine the terms of sale, and it must also determine the credit analysis. Yeah, what is credit analysis? This credit analysis tries to differentiate between good customers that will pay and bad customers that will default. Good customers means they will pay, and they will pay on time. Yeah, they will pay within the credit period. Bad customers, usually bad here means they default, but sometimes you can also include under bad customers those who delay. They don't default, but they delay. They pay later, much later than the credit period. So you can also categorize them as bad. So this credit analysis tries to differentiate. Okay, so this is important. The credit analysis is important because you need to identify the customers to whom you can give credit and to whom you cannot give credit, but you can make sales on cash basis, for example. So this, if you don't do your credit analysis properly, then you will end up giving credit to those who don't deserve credit, and you don't give credit to those customers who deserve credit. So in order to avoid these two mistakes, we call this type 1 and type 2 error in statistics. So in order to avoid these errors, this credit analysis must be good. It must be properly done. If your credit analysis is good, then you can minimize these errors. So you can choose the right customers to give credit to. Okay, so that's the idea behind credit analysis. So this comes under credit policy as well. Then you have collection policy. This also comes under credit policy. Once you have given credit, you must collect. So there must be an effort to collecting from your customer. Okay, for example, you need to remind them, call them, make site visits, make sure that they pay on time, and things like that. So this collection effort will also involve some costs. All these are costly. Nothing is cheap, right? Nothing is costless. Therefore, all this will involve some cost, but by giving credit, the idea is you can promote your sales, or increase your sales. So the increase in sales must offset all these costs that arises from the increase in sales. If it does offset and there's more you create value, then this value is for your shareholders, and therefore you create value for your shareholders. That is the motive, the goal of financial management, as we have seen in chapter 1. All right, I'm going to skip this because we have seen this in an earlier chapter, particularly in chapter 19. We have seen this in chapter 19, so I'm going to skip that. This tells you the timeline in granting credit. We have already seen that, so it's not so important. Let's move on to the next slide. Now we look at the terms of sale in particular. This is one aspect, one of the three aspects in the credit policy, right? We have seen that earlier. Now this term of sale, so we come to the second topic now. Terms of sale. This involves, as we have seen in the earlier slide, three aspects. Okay, so now terms of sales are normally given basic form in this manner: 2//10, then net 45. What does that mean? It means 2% discount. This 2 refers to cash discount. 2% discount. Discount here means cash discount if the amount is paid in 10 days. That means the customer pays within 10 days. This 10 here is the cash discount period. So this 2 is the cash discount. This is the cash discount period. Now what is net 45? This refers to total amount due in 45 days if this discount is not taken. So if you don't take the discount, you must pay the full amount on the 45th day. Okay, so that is what it means, this basic form. Now, so this is what is explained here. You would pay on either the 10th day or the 45th day only. Why? You won't pay in between. You won't pay on the 9th day, you won't pay on the 8th day. Why? Because there is no additional benefit from paying earlier than the 10th. Is that okay? If you get 2% discount, you get it when you pay on the 10th day. You get also 2% discount if you pay on the 9th day, or the 8th day, or even at time 0. You will still get 2% discount. So why do you want to pay earlier? There is no benefit. If you pay later, okay, you can earn interest from your funds. The funds that you have for payment, you can delay the payment until the 10th day and you still get the same 2% discount. So you won't pay earlier than 10th. If you do not take the credit, you take the cash discount. But if you take credit and you don't take the cash discount, you don't take the 2% discount, then you will pay on the 45th day. You won't pay earlier. A good company will not pay earlier. It won't pay before 10th, of course, but it will not also pay before the 45th day, because there is no benefit paying earlier. Okay, so if they want to take the credit, they should pay on the 45th day. They shouldn't pay later, but they should pay on the 45th day. If they pay earlier, there is no additional benefit from paying earlier. Okay, in fact, you lose the funds earlier. You pay your suppliers earlier. Okay, likewise the customers, when they pay the company, will pay on the 10th day if they take the discount. If not, they will pay, if they take the credit, they will pay on the 45th day.